And it is official. Welcome to another episode of Shut Up and Invest. This episode you don't want to miss, guys, because you hear us talking about it all the time. Be your own bank. This is where we talk about the moolah, the cash, the dinero. How can we create the funds? And this is actually a topic that's been on my to-dos, which is really look into the infinite banking concept that I've been hearing a ton about. And we got the man, the myth, the legend in the house that's going to be able to break that down for us, Mr. Chris Nago. What's up, brother?
Not much. Thanks for having me on.
Hey, Chris, good to see you, man.
Absolutely. Always good to see you guys and, be part of this and talk about this unbelievable thing that nobody seems to know about.
That is true. That is true. It's surprising how no one seems to know about it, right?
I like these episodes because I feel like I'm just like the listeners right now, where it's like, I have a ton of questions. Let's get down to the nitty gritty. But before we jump into it, Jay Money, what's going on, boss?
Hey, I'm doing good, man. I'm doing good. Enjoying this great Miami weather. Good to have Chris on here, man. Chris is somebody that I kind of found. I actually found him on Steve Train's show. So, which was, Steve, our buddy Steve, had him on a few months ago. And he's got a great topic that I just want people to find out about, man. Because we talk about being your own bank a lot on here, and I think that what Chris is going to bring is going to kind of combine the two worlds, exactly how you can actually do it functionally. So I'm excited for this episode.
Oh, we got even Toronto, Canada in the house. What's going on, guys? All right,
right above me, man. That's only a 2-hour drive for me.
Where are you?
I'm in Buffalo, so literally I'm just right below them. I hop over the border and I'm in Toronto in no time, but they don't want us up there right now. Us New Yorkers, they're like, you guys just stay down there. We don't want anything to do with that.
Now we're getting that in Florida as well. But before we start jumping into the infinite banking, I need to clarify something here because it will alter the way we go with this show. Are you a Buffalo Bills fan?
You have to be when you live in Buffalo.
All right.
It's mandatory.
Jay, you want to take over this?
Yeah.
I got something to do.
Well, here I got some good news. I don't really follow football, so I'm not your typical Buffalo Bills fan. But if you live here, you gotta support the local teams. I don't really follow Buffalo football or pretty much any of the sports here.
Kevin's a Dolphin fan, so you guys hurt his heart.
Squish the fish. Yes.
I'm a Steeler fan, so I got superiority over everybody in this room. But Kevin's he's a Dolphin fan, so he's got some animosity. I can see it in his bones.
I totally understand now. Absolutely understand.
Apparently, they're welcoming you in Toronto. I think both of you guys need to take your trash teams up there and just go have a party.
Hey.
Now that we got the business out the way, let's get down to the business. First and foremost, Chris, why don't we give kind of people an overall kind of understanding of infinite banking? What exactly does that mean compared to your traditional banking methodology?
Sure. It's easier just to take people back on a history trip back to where its origins started. And, it started way back with the Rockefellers and the people of that era where they really didn't trust banks. And back in those days, they had too much money and they didn't want to park it at banks. So they had to find a better way to do their banking. And where they landed is back then, and still true today, the safest financial institutions were big mutually owned insurance companies. So what they did is they found a way to create a banking system using these big mutually owned insurance companies. Because if you really look at insurance companies, one thing they're really good at doing is providing guarantees. They guarantee, if you crash your car, they guarantee if you graduate too early, just a nice way of saying die, graduate too early, they pay a death benefit. So they're always in the guaranteed business. So with money, it's nice to have that big G after your money, and that is the guarantee. So what they did is, in order to create a banking system, they had to find a mechanism to get into the insurance company's general account, because that's what they wanted. They wanted access to the returns that the insurance companies were getting on their surplus assets. Well, that's not an easy thing. You don't just waltz into a big mutually owned insurance company and say, hey, I'm here. Can I just give you my money and you guys pay me a return? Doesn't exactly work that way. So they found that the best way to create this banking system was using an age-old vehicle, one that many people have a misconceived notion about, called whole life insurance. Now, before we start losing numbers and watch the numbers, as soon as I say that word, people usually fall right off the live. But that really sums up the biggest problem. And it's what Will Rogers says. He says the biggest problem in America is not what people don't know. It's what they think they know that just ain't so. And if you think that whole life insurance is just for life insurance, well, you have an awful lot to learn. And that's what they learned. They learned that we can use this vehicle as a mechanism to get money into the insurance company's general account, which is where the return is. And then what they did is they found a way to create a system where the money can be deposited, taken back out, redeposited, and taken back out, which is kind of where the whole thing starts. The whole idea behind money and the misconceived notion of money is that we have been taught all wrong. We've been taught to believe that money, we've been taught to believe in compound interest, yet there isn't a business in the world that uses compound interest. Now, banks are what everybody says. No, Chris, you're wrong. Banks use compound interest. No, they don't. They pay you compound interest. They charge you compound interest, but they don't use compound interest. I mean, the last time you walked into a bank, think about it. Did you go into the bank and write your name on your $20 bill? I wish I had a $20 bill, but you write your name really big on it. You hand it to the teller and you say, Mr. or Mrs. Teller, can you put this $20 with my name on it in my little box in the back? And I'll be back next week or the week after to grab that. That's not how banks work. Banks take that $20 and they lend that money out right behind you in those glass cubicles. So what banks have become very good at is moving money. Same thing with grocery stores, car dealerships. Grocery stores move inventory. Car dealerships move cars. Every business in the world moves inventory, which is the same as moving money. So why are we taught to then go in, deposit our money, and just leave it sit there? Because we've been brainwashed to believe that that's what we have to do. Well, the smart money, the big money, and the wealthy, they do things different. So they understand to make money on money, that money needs to be moving always. It's a law of nature. Everything is moving. I mean, you got cars outside your place moving. You got planes flying over, or maybe not. You got the wind blowing. Everything's in motion, but our money is not in motion because we've been taught just to park it or give up control of that money. And then somebody else is in control and moves the money for us, and they make unbelievable amounts of money. How much? I get asked this all the time. Banks make 400 to 1,300% more than you do on your deposit. So you got to kind of say, should you be mad at the banks, or should you just learn what the banks do and why they do it and mimic the banks? Well, I think option 2 is the smarter way. So infinite banking is the ultimate way to move money. Your money needs to move like a big flowing river. And when you have more of it, your river gets wider. And as you have less of it, your river contracts. And the last thing you want your river to ever do is or your money, which is the river, you don't want your money to take a little side off into that creek that lands in that stagnant pond where your money sits and dies. But unfortunately, that's what we do with our money. We park our money at banks. Where at the bank, how much do you make on your interest? How much are you guys getting on your bank accounts?
Tell you, you're lucky if it cracks.
We get money on those? We get interest in the bank?
Oh, yeah, I guess they do pay interest. I had a live that I did last week, and I found somebody that was making 1.4%, and they were so proud of it. And I was like, I felt like reaching through the Zoom and patting them on the back and say, good job. Good job. You found a bank paying 1.4. By the way, that was variable. But then I had to bring the realization that at 1.4, if inflation averages 3.2, how much money are you losing? Well, the difference between 3.2 and 1.4. So you're always losing money when you're doing it that way. The second thing we've been taught to do is put money in retirement plans. I'm not saying 401ks are a bad place, but the way we've been taught to do this is we give up control of our good dollars today, the dollars that are worth the most today, which is your dollars you have. If you think your money's worth more in the future, you're sadly mistaken, because inflation, the hidden tax, steals your dollar's value. And people, just let me clarify what inflation is. Inflation, as most people know it, is when they go to the grocery store, the cost of milk and bread goes up. But the cost of milk and bread doesn't actually go up. It just takes more of those dollars to buy that same loaf of bread and that same gallon of milk. Because every time the government prints money, I think, what are they up to? 3.2, 3.3 trillion right now?
Yeah.
So they print money. And that money has to get value from somewhere, because inflation is essentially what that means is when the government prints money, it steals value from your current dollars. Many, many years ago, the leprechauns found a way to make a rainbow right over to Fort Knox, and they stole the gold. So now our money is just based on really nothing, but it steals value from your dollars. The dollars in circulation, when they print new money, become worth less. So inflation's an issue, but the problem is when we give up control of our best dollars, our dollars today, and we put them somewhere, that money's just sitting there. And we do this because we want to make a return on our 401k, and that's the stock market. So I don't know how all of you feel about the markets, but if you think the markets are just going to keep on this little trail up and up and up into the stratosphere, you're sadly mistaken yourself. But over a long time, money makes money, and in the markets, you'll make money. But the problem with that right there is by giving up your good dollars today, the dollars you could use for opportunities today, the dollars you could use to go buy that real estate deal that comes up, the dollars that you can use for any opportunity, that comes about, are parked with somebody else that you can't get control. Because once you give money to your 401k, taking that money back is more difficult. Comes with fees, comes with taxes sometimes, IRS penalties. There's ways, but let's just assume that once you put it there, it's going to sit there for 5, 10, 15 years until you reach the age of 59 and a half. Then you can take that money back. So why is it that we've been taught to do these things with our money when literally we would never do the same thing we do with money with the things money buys? Would you ever buy a loaf of bread, come home, put it in your freezer, and wait 5, 10, or 15 years to eat that loaf of bread? Heck no. That thing would be, I don't even know what it'd be. It'd be something you wouldn't eat. You wouldn't buy that new car that you've been dreaming about and then wait 5, 10, or 15 years to drive that. Funny story with that. I had somebody actually tell me that they did that. They bought one of those Dodge Demons, fast car, and they park it. They literally just store the car because they said it's going to be worth money in the future. I'm like, tricky. I said, how about this? Would you ever buy your dream house and make your spouse wait 5, 10, 15 years to move into the house? You never would. You would be divorced. But that's what we do with our money. So
Chris, I'll tell you what, sorry to interrupt.
Please do.
We have a confession on the show. Jory buys his sneakers and stores them for a few years and then comes out with them where the value has raised, and he says, I got the brand new J's that they're no longer out, the brand new Air Maxes. This is a problem. This is like, we have an issue with this.
Hold on. It's not exactly that. See, when I go on these spurts, when I used to go on spurts with mine, I didn't want my wife to think I bought 3 pairs of shoes in 3 days in a row. So I would store them. So when I brought them out a month later, I'd say, hey, I just bought these. That's more what it is, Kevin.
My wife does the same thing.
That was the old Jory.
Well, thanks. Sometimes you just gotta, come out with it because the truth hurts, but it's okay.
Real quick, Chris, let's just go back a little bit because we'll bring it down some. But one thing people always that you said is this has been around for ages. The Rockefellers, those people back then were using it. And one thing that you get is that, we do a lot of creative stuff, right? We do a lot of stuff that's not the traditional way. And they always think, you can't do it that way because we weren't taught it, or that must be some kind of new way of doing stuff that who knows if it, but actually what you're talking about right now is older than the traditional banking system, correct?
Yeah, and older than the tax code, which brings us to some interesting tax advantages with these, because this was created by the wealthy for the wealthy back before the tax code was written. So when the tax code came out in 1913, some little things just kind of went right up and around that tax code. We'll talk about the tax advantages later.
Mm-hmm. Got it. Yeah. So these are things that were around before then that have been used to create generational wealth, right? Before we had tax laws and all kinds of banking laws that people just don't know about because they haven't given us the knowledge.
Correct. I mean, and it's funny, like a lot of people, when they hear about this, they watch one of my videos, they read my book, the first thing they always say is, how have I not heard about this before? This is insane. And I've never heard about this. And the first thing they say is, number one, it sounds too good to be true, which when something sounds too good to be true, we've been taught to believe that it must be. But it's not that it's too good to be true. It's just you've never seen how uninterrupted compound interest actually works. But Albert Einstein understood it. He wrote about it in his books. He said uninterrupted compound interest is the 8th wonder of the world. And those who understand it earn it. Those who don't pay it. You think, do you think the banks understand it? Yes, because we pay the banks uninterrupted compound interest on our money or credit cards and our car loans. But yeah, so you're right. It's been around forever. This isn't something new. This isn't some new, hocus pocus thing. This is actually, in my opinion, knowing it so well, it's freaking boring. It's boring, but it never, ever fails. It can't fail because insurance companies, like how this works. And let me just kind of take a step back. Now that you understand.
kind of break it down exactly.
Yes, please.
We'll know what you're talking about.
Yep. So now that you understand how this happened, where it came from, and you understand the history, and what we're trying to do is mimic the banks. Here's what you're doing. You're finding somebody that understands how to create one of these banking policies, which is the specially designed and engineered whole life. Now, this isn't walking into the insurance store and buying a life insurance plan from your insurance agent or your financial advisor. They won't have a clue how to do this. And if they do, you got a good one. But you start this specially designed and engineered whole life. And all we do is change one thing. Right now, your money's going somewhere. It's going to a checking account, a savings account, a CD, a 401k. And we change one thing, and that's where the money goes first. So we redirect where that money goes, and it goes into this specially designed and engineered whole life. Once it hits that whole life, here's the first thing that happens. The insurance company guarantees you a 4% interest rate. 4%. And if anyone on watching this is getting more than 4% in their bank account, please tell me which one, because the highest I've ever seen is Federal Credit Union. They pay 3.5% on their checking accounts. I think it's checking accounts, but it's only on $3,000 or less. So if you got something that pays 4%, great. You've got something better than what we can do for you. But then the insurance companies, remember, they're mutually owned. They're not publicly traded companies. So dividends are what people buy stocks for. Well, these whole life policies also pay dividends, but they pay dividends to the policyholders, not the stockholders. So let's just pick on Mass Mutual, one of the biggest companies in this space. Mass Mutual right now pays a guaranteed 4% interest on your money. So everybody would be excited to earn 4% on their money, but then every year you get a dividend, which is a return of surplus of 2.2. So 4 plus 2.2 means that your money that you put into this account earns 6.2%. But if this were one of the perfect places to put money, the number one thing you'd have to have is access to that money, control of your money, which is single-handedly the most important thing. Every single person in the US and in the world, Canada especially, they need to get back control of their money. So how do you get back control? It's easy. You have control from the start. So you put this money in your account, you immediately, in the first 30 days, can take that money back out. Now, how much of that money can you take out? Well, it's going to be anywhere between 60 and 90%, depending on how we design your plan. So you put money in and you take money right back out. But here's the kicker. Remember, I told you you're making 6.2% with dividend. What if when you took your money out of this account, the insurance company continued to keep paying you that 6.2%? Let's just call it 4% plus the dividend. I want to be clear. It's not 6.2, it's 4% plus the dividend. And in 2020, the dividend's 2.2. Wouldn't that be a pretty cool thing if you could go to your bank, deposit money, walk back in your bank 30 days later, take some 60 to 90% of your money back out of the bank, but then the bank teller says, hey, thank you so much for banking with us. We're going to continue to pay you that interest rate on your money. And when you take your money out, all the bank's going to do, which is the insurance company, is they're going to charge you interest on that, because what they're doing is giving you a loan. But when you think of a loan, don't you have to pay a loan back? You see, correct, with these specially designed and engineered whole lives, with these insurance companies, when they make you a loan, all they're doing is they're giving you money from their general account. They're going to charge, right now, it's 5%. So you're making 6.2 and you're paying 5. So your spread is 1.2 in the first year. So you got this money, you're paying 5% on that money, but the whole thing is that loan essentially really never has to be paid back. You've never been able to walk into a bank, take a loan out, and the bank just says, hey, if you want to, you could pay this loan back and then we'll give you more money, or you don't have to pay the loan back. If they told you that, you would be like, did I arrive in like a fairy tale land, or what the heck was I doing before I walked into this bank? Might be your second thing. So now you've got this loan that you don't have to pay back. You're probably wondering, well, how can that be, Chris? That just sounds too good to be true. Not at all. You see, that whole life also has a death benefit. The insurance company promised they're going to pay a death benefit someday when you graduate. And I don't mean high school or college. I mean the big graduation day. When you graduate, they're going to pay a death benefit to your beneficiaries. So when you borrow money from your policy, the insurance company gives you that loan. It's just leveraging your death benefit. So your death benefit reduces by the amount of money you take as a loan. So essentially, the insurance company gives two craps whether or not you ever pay that loan back, because they're going to true up the day you graduate. So to them, it's all the same. It's a push of numbers on a screen. So that's the whole idea. So let's recap that real quick, simply. You now found a place where you can deposit money and you can get 4% guaranteed on your money plus the dividend. But then you just learned you can take that money immediately back out within 30 days, or when your check clears, you can take some or a good chunk of that money back out, 60 to 90% back out as a loan, but your money still continues to earn interest, which is now called uninterrupted compound interest. And now you got this money. What are you going to do with it? Well, that's where the real trick of this comes in. And this is where we have to learn the banking functions in our lives. So let me give you an example of one thing you can do with this. You could take that money. Let's just say you owe Visa 10 grand. So you put in 15 grand, you take 10 grand out. Okay. You take the 10 grand and you pay off your Visa card. Okay. So you paid Visa off, and Visa was charging you 20% interest. Freaking crooks. But anyway, you paid them off, so they're out of the picture. But now you got that $200 a month that you used to just graciously give to Visa because that's what you had to do and that's what you were taught to do. We take that $200, and instead of giving it to Visa, we're going to now give it back to your bank because you're the bank. So if you want to be good at this business, you have to be an honest banker, which means you should take the money that you freed up and put it back in your policy, which means now you're repaying the loan to the insurance company, making $200 a month immediately available to you. And now you're paying the insurance company less interest, but your money never stopped earning interest. So I know you read the book and you've seen the video, but the thing that people don't comprehend is how uninterrupted compound interest actually works. Right now, they're just doing the math. They're like, all right, so if I put 10,000 in, I make 4% on that, or 6.2. I'm not really excited. But what you don't understand is, remember, the second you make that deposit, your money never, ever stops earning interest, which means next.
Real quick, Chris. So like, just to clarify, right? You put 20 grand into the policy and you take a loan out for, let's say, 15 grand. You're still making compound interest on the whole 20 grand, correct?
100%. Mm-hmm. Correct. Every penny of it. And it will never stop. There's not one thing. And well, you could graduate, but that's the only thing that would ever stop that uninterrupted interest, period. And you could just, let's just say like you get to year 5, you put in 20 grand, and then 30 days later, you go back to your account and you take 23,000 back out. Now, why did I use 23,000? Because now you're like, wait, I just put 20 in, and 30 days later, I take 23 out. Oh yeah, that's exactly what I mean by uninterrupted compound interest. Have you guys ever heard the saying, it's been around forever. Would you take $1 million right here and right now, or a penny doubled every day for 30 days? You've heard of that one, right?
Yeah, definitely.
So what would you take, the penny, or would you take the $1 million?
Well, knowing what I know now, the penny. But
right. But most people,
head Jory would have took the $1 million.
Most people would take the $1 million. They'd be like, oh, give me the $1 million and I can turn that into 2. Okay, great. What if you could take the $1 million and turn it into 3 because you're really good at real estate? Great. But you know how much money you just gave up by not taking that penny doubled every day for 30 days, which is truly uninterrupted compound interest? Well, if you did the math and you looked at that equation, it's 5.3 million. So there's no way you could ever take $1 million and make it into 5.3 in 30 days. I mean, well, you could go buy a bunch of lottery tickets and maybe get lucky. But you see, like, that is what I'm talking about. This vehicle is the only vehicle on earth, the only one that we have found. And if somebody knows of a different one, I will change all of my presentations. I will change every live. I'll take down every podcast I've ever done, and I'll redo it using your vehicle. The reason I can say that is for hundreds of years, there hasn't been a vehicle that can do what you just heard me explain, except for this stupid whole life, which Dave Ramsey and Susie Orman have told you is a terrible place to put your money. And you know what? I agree with Dave and I agree with Susie, because they're talking about regular whole life. They're not talking about building a whole life this way, because if they were, they would basically see this completely different. And the reason people don't know about this is so simple. I get asked this every single time. How come I've never been shown this? Why didn't my financial advisor show this? And just so everybody knows, for the record, I was a high-level financial advisor for 16 years of my life. I retired in 2018 when my wife and I got a show on HGTV because they didn't want me having a show with being an advisor. Never once in 16 years was I taught about this. Not one time, which blows my mind.
You were actually selling the products as an advisor. You never
100%. I was selling regular whole life, which I understand how whole life works at a level that not many would be able to, to kind of, catch me off guard on that. But this is not regular whole life. This is using whole life the same way banks have been using it. And, a lot of people are like, well, all right. So now you got my attention, but I still have a lot of questions, and that's good. You should, because the number one thing you should do is you should Google the word bully, BOLI. And what you'll find is it stands for bank-owned life insurance. You will find hundreds of pages showing you how much money banks own of whole life. Matter of fact, banks are the number one purchasers of these silly whole life policies. They own more whole life than they do all the land and the buildings combined. Think of Bank of America. You guys should look at the financial statement from Bank of America. Look at their balance sheet. Look at how much money they have in real estate and look at how much money they have in whole life. Challenge yourself. I'm not going to tell you what it is. You will be surprised when you see that. And you will start asking yourself, well, you'll one of two things is true. Either banks are stupid or they know something you don't know. And I'm going to tell you the answer. They know something you don't know. They know the same thing that Walt Disney knew when he started Walt Disney World using his whole life policy, New York Life for the matter. How about Ray Kroc? Pretty good businessman. He did a good job. Okay. Ronald McDonald campaign started with whole life. J.C. Penney started with this. Sears started with this. Pampered Chef started with this. I could go on for days with this stuff. Today, it's used by all the wealthiest people you know. And I don't know politics, but I'm just going to talk about two high-profile politicians. Biden and McCain both have openly said that they use privatized banking. And privatized banking and infinite banking, folks, is the same thing. But you've never been shown it because there's not an advisor that either was taught about it. And even if they were, they would have to give up 60 to 90% of their commission or their paycheck in order to do this for you. Do you remember I said you have access to 60 to 90%? Do you know where that comes from? The advisor or the agent writing the policy has to give up their commission so that you have access to your money. Novel idea. It's crazy to think about that, right? All these years. And all we needed was some advisor to give up 60 to 90% of their money and have a little knowledge for me to be able to do this. But yet they never have. And I'm not going to go deep into why, but I was an advisor and I even asked my managing partner this question. And the answer was good. But it basically means that this will probably remain a secret above and beyond people that are seeking the knowledge, like all of you watching this podcast, for a very long period of time.
Chris, can you break down how easy it is to confuse the two and what are the differences between the traditional whole life policy and what you're breaking down for us?
Sure. It's actually really easy to understand. First off, you got to find a mutually owned insurance company that's paid dividends. And I would suggest finding one that's been around for 100 plus years. Okay. So that's your first thing, but that's easy to find. You go out and you find Northwestern, you find Guardian, you find, there's a whole bunch of them. But then the tricky part is finding the ones that actually support infinite banking. Northwestern does not. And many of the other big ones, they do not. So how do you know the difference? I'll tell you. Have an illustration done by your insurance agent and just say, hey, look, I want to open one of those banking policies. Can you come up and do an illustration? Most advisors right now, what you will get is not even a whole life. They'll give you one of these. Can I swear on here? Let me not. One of those garbage IUL policies. Index universal lives. That's the number one. That's the flavor of the week. You know, it's like today we now have, the twist, the vanilla and chocolate, but now we're putting strawberry in it. It's the flavor of the week. And that's all it is because it pays a huge commission. So that's the first thing most people get. But if you're lucky and you got an agent or an advisor that does a good job and gives you a whole life, what you're going to see when you look at that illustration is you're going to see in year one, there's hardly, if there's no cash value, if maybe a little bit. Year two, same thing. No cash value, maybe a little bit. Year three, you got a little bit of cash that you can use. But wait a second. Chris just said that if I deposit money, I immediately in the first 30 days can just take that money back out 60 to 90%. So if you want to know the difference, that's how you know. One is very different than the other. I'm telling you, there's a massive difference in how these are designed. But it's actually, once you learn it and you learn the ins and the outs of what works, it's just a system. You just follow the system.
Got it. And kind of talk to the point, if you're in the financial analyst world or a financial advisor, they're selling us products, right, based off of a commission or a structure or a bonus structure. So it doesn't mean that it's the best product for us. It's the best product for their pocket to bring the highest commission, correct?
Correct. Now, you got to understand, I was an advisor for 16 years. I'm not trying to, beat up on advisors. Look, that's where I come from, right? Mm-hmm. But one thing I will tell you is when I was an advisor, and I was at an extremely high level, folks, you can look me up. When I was an advisor, I was taught to sell products that paid us the biggest commissions. Why? Because the brokerages get paid the most by doing that. I was taught to sell variable annuities, garbage. I was taught to sell mutual funds, sometimes high fee mutual funds, because We were taught that. It's not because we were dumb, not because we were doing the wrong thing. It's because that's what we were taught. Just like all of you were never taught how to make your money work for you. You were taught how to go out and earn money, but you were never taught how to actually make your money work for you. And you certainly were never taught how to move your money, because that's been reserved for the wealthy and for the banks. And if, oh my gosh, if you knew how to become your own bank and how to move your own money, why would you need Visa and Amex banks? Why would you need them? If you could just be your own bank, pay yourself back with interest instead of paying Visa with interest. It's way more fun, folks, to write a check to yourself with interest than to pay Visa or somebody else a check with interest. I'm telling you, it's a totally different environment. And you know, you've heard this, but my favorite thing to teach is I show people how to use this infinite banking concept, and I can do it in 10 minutes. I show them how to get all the money back for every single car they will ever buy, drive, and own. Now, most people, as soon as I say that, they're like, nope, no way possible. Oh, folks, it's so simple. And a matter of fact, not just so simple, I've done it 3 times now. My newest purchase, which is my wife's Porsche, we bought that for her, and we bought it with our bank, and I make a payment back to my bank every month for $957. And it is my favorite $957 check to write every single month. Actually, the bank does it because it's a bill pay. But like, I'm not boasting about a Porsche. It doesn't matter whether it's a Ford Focus or a Ferrari, folks. I can show you how to get all the money back for every single car you will ever buy, drive, and own by changing one thing. And that one thing is what we're talking about here. Change where your money goes first, and then pay everybody else with weaker dollars.
Got it.
Sorry, I get really fired up about this. I'm sorry,
no,
guys.
Believe me. Listen, I just finished the book, man, so I'm fired up too. It was a good
I just
book.
love this stuff, and I can't get enough of it.
Chris, is there a limit to how much I can contribute towards the policy?
Unfortunately, there is. And that limit actually just came down substantially because of COVID. So the max amount one can put into these policies per year is $1 million, which I know, you know, a lot of people are like, oh, that's a lot. Well, if you're a wealthy individual and you want to put more than that in, that sucks. It really does. And I've had these people that have said, hey, I want to put 2 million in. I'm like, sorry, man, capped at 1 million. That they get pissed off.
What about the a minimum, right? Because what if somebody says, hey, I don't have, I want to put a couple $100 in. I got $500 a month. What about the minimum? What's the minimum?
Perfect. It's very easy. So take your age. I'm 43 years old. Multiply it times 10. That gives me $430. $430 per month would be my minimum. Age times 10 gives you your minimum monthly.
Wow. Okay.
Mm-hmm. It's the easiest way to do it. Anything less than that, it's not going to work.
You talked about the, this being around before the tax, right? The tax bill of 1913. So what are the tax? Is this money taxed, right? When I make a loan to myself and I pay it back, what are the tax implications? How is it affected by taxes?
Tax free. You put money in, that money grows on uninterrupted compound interest. You take that money out. Remember, you're taking a loan. So there's no taxes on loans. Now, most loans, you take a home equity line of credit, a HELOC, you take that loan. Do you pay tax on the equity that you just took out of your house? No, you do not. When you refinance your house and you pull the equity out, do you pay tax on the equity you just took out of your house? No, because essentially you owe that money back. Same thing here. You see, it's a loophole, but it's one that will never go away because all the wealthy people have their money here. It's tax-free, tax-deferred, and the benefit is when you graduate, this is the legacy play, that money, whatever you didn't use during your life, is passed on tax-free to your heirs, to your beneficiaries. Why do you think the wealthy, the Rockefellers, the Rothschilds, every time one of them dies, they probably have a party because now all of a sudden their trust funds get reimbursed or get, a couple, I don't even know how big they are, but millions and millions of dollars. And then that funds the next generation's whatever they do.
True. This is true generational wealth. I mean, you're building
100%
wealth because you have the cash value on one side, right? Then you have the death, what is it called? The death benefit, whatever it is, which goes to the next generation, right? So I think it was in your, because I found infinite banking concept. I want to ask you this real quick. I was actually Googling on YouTube, becoming your own bank, because I always talk about being your own bank through real estate notes. And the name Nelson Nash popped up. Kind of tell people real quickly about the significance of Nelson Nash.
Nelson Nash is kind of like the godfather of the infinite banking concept because he took what was before him kind of reserved for the wealthy. The wealthy knew about this, but nobody else did. And he figured out how to actually go to these mutually owned insurance companies and create these banking policies the same way the banks were and the wealthy were, which wasn't an easy mission for him because he had to literally create this entire system. And what he did is he brought this, he wrote a book called Becoming Your Own Banker. All of you should read Nelson Nash's book, Becoming Your Own Banker. Unbelievable book. In that book, basically breaks this down. And a lot of people right now, you're so focused on that whole life because it's the one thing that you know, but you're still a little leery because it's against everything you've ever been told. But Nelson goes on to tell, and we teach the same thing, that it's not about the whole life. The whole life is nothing more than a really good machine to move your money, because that's all we're using it for, just a machine to move your money the most efficient way. Nelson talks about the banking functions in your lives. What are you doing to take back the banking functions? Because if you wanted to really build wealth, and I love this is one thing what Nelson said, and I'll never forget at the time I read this, is the first thing that rang out. He said, if you want to build wealth, the best and easiest way is just to go back and take back the money you're giving away to everybody else. Think about that. Go through your checkbook every month. Go through your bank statement. Who are you writing checks to? And if you just took back, let's say 80% of the money that you're writing checks for or paying to other people, if you could just take that money back, how wealthy would you be? I'll tell you right now, it would change everybody's life. And the easiest thing is it's super easy to do. You just have to focus on the banking functions of moving your money. Money over here pays down debts over here, recapture the money that you used to just give to everybody else, put it back in your bank. Now, all of a sudden, you get to reap the benefits of all the money that you're giving away. It takes time. It's not going to happen overnight. But that book, and I think, Jory, I think you'd understand, or you say the same thing. That book was life-changing for me and for millions of other people, because it showed them the first steps of what this can look like and what your life can be.
Oh, it definitely did. I mean, I read that book and it just showed you how you can actually do it. And it makes total sense when you're just paying yourself back for all the stuff you're buying, right? So instead of paying interest to the car dealership, right, I buy that car with my money in my infinite banking, policy, and then just pay myself back per month. You're forcing yourself to save, right? But your savings is actually getting interest on it instead of just putting it into the bank. I mean, it was a light bulb went off, and I was like, "Wow, this is insane."
You're probably like, "Oh my God, if I can do this for a car, or if I can do this to pay my credit cards off, what else can I do it for?"
And we'll get into that. Yes.
Real estate.
Chris, we got a question before we jump into some of the real estate examples that I would definitely want to get into. Luke's asking, can you talk about what happens to your cash value when you pass away, aka graduate?
Luke, it's a great question. They just send me a check for the amount of your cash value. I'm totally joking. So what actually happens, and it's a great question. So when you start with a base death benefit, right? And a death benefit that will be paid out the day you die. But then over time, you build up all this cash value, right? All this money. And if you graduate too soon, or you just graduate and there's all this money in there, what happens? Does the insurance company just keep your cash value? Absolutely not. You see, every time you make a deposit into these banking policies, your death benefit goes up. Deposit, death benefit, deposit, death benefit. You see, there can never be a time where you have more cash value than you do death benefit. So in order to make that work with these plans, every time you make a deposit, your death benefit has to go up because of just the sheer nature of how these work. So you are going to get the benefit of that cash value. It might not be dollar for dollar, but believe me, you're not going to be upset when you see the death benefit amount. So it's all just part of that equation on how they factor your death benefit at the day you graduate. And it's going to be significant. There's not one plan that we design that starts at a death benefit and is the same as the day that person graduates. It's significantly higher.
Awesome.
Chris, can you break down a couple of examples of how people are using this in the real estate world?
Oh, yeah. I mean, I literally did. I wrote the book on it, but I want to write part 2 of that all about real estate, because I feel like in this infinite banking space, it is relatively new to the general public. And I feel like I'm one of the first real estate investors to really embrace it and start using it. So how did I use it? Very simply put, you already understand the concept: money in, money out. Well, we need money for real estate, right? So I'm putting money over here. And as it builds up, or as I pay things down, it keeps building up and up and up. I go out and I buy, let's just say I buy a duplex today. And that duplex is $100,000. Now, I can take that duplex and I can take it to the bank, and the community bank will give me 80%. But now I need 20% plus the rehab. So when I first started using this for real estate, that's what I was doing. The community bank wouldn't give me all the money. So I always had this shortfall of 20%. And normally that 20% would either come out of my checking account or I'd have to go borrow it. And I said, wait a second, I got this money in this banking policy. What if I just loan that money from me to my LLC, my company, and I charge my company 6%, which is the amount I would have given to the bank anyway. So I loan the money to my LLC. Now I've got this duplex. And remember, the loan that I make to my LLC, do you think if for some reason my LLC can't make the monthly payment, do you think that's such a bad thing? Nope. I'm just like, I slap my LLC on the hand. I say, don't you ever be late again. But I'm the bank. I set the terms. I set the repayment. If for some reason that duplex takes longer to renovate, or for some reason I can't rent it out and that LLC doesn't have the revenue to pay me back, oh darn. All I'll do is I'll just kick the can down the line. So then that LLC pays me back. My LLC is now paying me back with interest. So my LLC gets a write-off for that interest. Now the interest that's paid to me personally is taxable. So let's just call that a wash, but it doesn't matter because what I've done here is now I'm making money on the LLC, on the real estate, and now I'm making money on the banking functions. So I'm making money twice doing the exact same thing I would have done anyway, except for the way most of us do it is we give that money to somebody else. A credit card, a home equity line of credit. And I'm not saying that's a bad thing because it is going to take several years to capitalize your banking system the way that I'm explaining. But what's a couple of years when that couple of years will pay you for the rest of your life? It's a blink. That's what it is. So that's the first way I started using it. And I built up a portfolio of over 90 rental properties doing that exact same thing. And then I got really good at the BRRRR strategy. And I said, okay, well, this is even better. I borrowed money privately, and then I would use my banking policy to pay the interest on those private loans. I'd then take the same deal when it was all done to the bank, refinance it, pay that private lender off, and then pay myself back as well, or just have that rental income start paying me. You see, understand you have to be an honest banker. Sure, you could get loose with this and get really sloppy and just start taking money from your plans and never do the recapture. And you know what you're doing? You're failing yourself. That's all you're doing. You're just not being an honest banker. And the funniest thing is if you're okay paying the bank's payment every month with interest, why would it ever be a problem to pay yourself with interest? Matter of fact, you should want to pay yourself with interest because it's way more fun making those payments to yourself than it is to somebody else. So let me go one more round. As I started getting good at this, okay, and I started doing this in 2014, I had a mentor, okay, his name is Greg, and Greg always talked about being the bank is the ultimate in real estate. But I always thought to be the bank, I had to have millions of dollars, right? So that wasn't the case. But what I started doing is as I started building these banking policies through all this money in and money out, I then started saying, why am I spending all this time flipping houses? Because I hate flipping houses. No disrespect to flippers. I've done 260 of them and I hate it. Every last one of them I hate, but I make really stinking good money doing it. That's why I keep doing it. But what I started saying is, why don't I just find a way to make money on the flips without having to swing a hammer, deal with a contractor, deal with a building inspector, just by being the bank. So I then started lending money for my banking policies to other real estate investors, and I would charge them 12%. I still do this today. I have 3 deals on my desk right now that I'm funding with this banking. So now I took the money from my banking policy that's paying me 6.2%. I lend it to, XYZ company over here to buy their flip. XYZ company has to pay me back every month at a rate of 12% interest. And then when that house sells, I'm a first lien holder. So when it sells, I don't need them to write the check. The attorney or the title company writes my banking policy a check and I'm whole. Rinse and repeat. Once I figure that out, I'm like, oh my goodness, I just found the ticket. And I have been doing that and teaching that and showing people the proper way to do this so that they don't get themselves in trouble. And that's how I've been using it. And I think I'm just scratching the surface on the ways to do this, because we could talk about so many different ways that you could use this in different aspects of real estate.
Yeah, and the one thing that when I actually met Chris, I was talking about how you could actually use the policy, because we do a lot of stuff as far as notes, right? Where we're not landlords, we're just notes. And my thing was I could use these policies to purchase these properties that I sell on note and then take the the homeowner's payments back into the policy. And now you're literally a mortgage company and a bank all in one.
Absolutely. Yeah, you are. Oh, that's fantastic, man. I love that. And I don't do notes. So I got a lot of respect for, those that understand notes, because I just think the note business is like an untapped potential that not enough people are doing. But you then take and add your banking system to that notes business. Whoo-wee. You are just printing money, literally. And you're never going to get a call on a Sunday, on Easter, on Christmas with your tenant saying, hey, Chris, I'm sorry to bother you on a Sunday again, but the basement's flooded and there's brown things floating around. That's not the call you deal with in notes. That's the call schlups like me that are buying the actual properties deal with. And you know what? That's how we make money. So we just keep doing it.
Mm-hmm,
Chris, Candace is asking, how do we get the book?
Oh, yeah, I'll give anyone watching this podcast, I'll give you a copy of Mapping Out the Millionaire Mystery for free. You just got to pay the shipping. And if you don't, I literally get people that like yell at me because I'm charging them shipping to ship it to them now. So I'll go one step further. If you're too cheap to pay the shipping for the actual book, I'll send you the ebook for free. Just give me your email. And how you give me your email is right there, chrisnoggle.com. And you just send me your email and say, give me the ebook. I was too cheap to pay the shipping. But yeah, so anyone that wants the book, right there, that link under my name, chrisnoggle.com/resources. If you do that link, it'll bring you right over to the resources tab where all the free trainings are. You can watch all the trainings that I do on this topic, but also right under, it's 2 swipes, okay? Free book. You can get a copy of Mapping Out the Millionaire Mystery for free. Heck, you can get this one, The Private Money Guide, How to Find Money Without Asking for It. So both of them free. Take them.
Yeah, I read the book, Chris. You see it's right here. I read the book literally in like 2 days. You know,
I'll do that.
Read it in 2 days, man.
I'll never forget it. And I wish I could show it to the audience. You sent me, or I think you just posted it, a photo of you head down with BYOB on his shirt. Okay, right across the front. BYOB, become your own banker. And he's just intently staring at my book. And that picture literally was my favorite picture I've ever seen of anyone, because not just because it was my book, but just, I don't know, there's something about it, just how intently deep you are into that book. It's a special picture to me.
Yeah, my wife took that.
I sent him a box of books just because of that.
It's some kind of buffalo shirt. I'm gonna give it to Kevin. He sent me a buffalo shirt. I'm gonna drop it off at your house, Kevin.
Yeah. I need a dish rag.
Squish the fish.
We got Joe asking, is it smart to open several or just focus on one policy until you get the hang of it?
Great question, Joe. So I have 7 banking policies, and it's not because I want 7. It's because that just will happen. You see, if we could just do this with one, that would be great. But you see, the IRS had other plans. When you set your plan up, let's just use round numbers, right? Let's say you build your plan at $10,000. You call us and we build it for 10 grand. $10,000, the amount that you told us you want to deposit, that's now your new ceiling. You can never put another penny more than $10,000 in your plan. You can always go down. So you could take that 10 grand and reduce it down to 4 grand, but you can never go higher. So what'll happen is you got this plan at 10 grand. You start using it the way we're talking. You pay off Visa, you pay off Discover, you pay off Home Depot, you recapture that money. Now all of a sudden you got all this extra money that you didn't have to work any harder for. You just simply changed one thing and more money appeared because you took the money back, and you want to put that money in your policy. Unfortunately, you can't, because of it's called the Max 7 pay rule. Whatever we build your plan at, we're going to build it right underneath the IRS rules, meaning you can't put a penny more. So therefore, the only way to get more money in is start plan number 2. We call it branch office number 2. Because remember, everything we're doing is mimicking what the banks do. So why not just call it what it is? We're going to start our second branch, our branch policy number 2. And that's how I've gotten to 7 of them. And I'll never stop until the insurance company says, you can't buy any more. And that will happen because there's this human life value where the insurance company won't let you buy more of it.
I think I read Nelson Nash had like 30 or so. Like, what was the number he had?
I think it was 32 of them. But there's a story behind that. They're not all, he's not the insured on all 32, but he's the owner of all 32 of those. My mentor, Brent Kessler, has 19, actually soon to be 20 on that he's the owner of. See, with ownership comes control. Whoever's the insured, whatever. So, if you just look at, well, you read the book, but if you look at what banks do with this, banks can't be the insured on a policy. So they need to borrow a life is the easiest way to say it. So what they do is, you ever been into a bank and not seen a vice president? They walk around in their suits with their, gold or black, name badge. It says vice president of janitorial, vice president of coffee. I'm joking. Listen, if somebody's working at a bank, I try to make this as fun as it can be. But why does a bank need so many darn vice presidents? Well, let me give you a little secret. Because that's how they buy whole life. Because as they promote you to a vice president, you become an insurable interest by the insurance company world's definition. You're now an insurable interest of that bank, meaning if you died, that bank has a financial loss because you died. You're an executive. So for being an executive, the bank says, hey, we're going to give you a deferred compensation plan. We're going to give you an increase in pay, and we're going to give you a fully paid up life insurance plan so that the day you die, your beneficiaries can be named named by you, and they'll get $100,000. And the employee's like, holy crap, I got a raise. I get one of those black name badges that says my name and VP, and I get a deferred comp, which, by the way, is funded by the whole life, which means someday, 20 years, I get a paycheck for the rest of my life. So they're psyched. The employee's excited. Honey, we got a fully paid up $100,000. Don't you dare think of doing anything at night when I'm sleeping. Anyway. So now what does the bank do? The bank now says, awesome. All right, guys, call Mass Mutual. We need another one of those $2 million policies, those whole life policies on Mr. VP we just promoted. The insurance company says, no problem. So they give them that whole life, and the bank does exactly what we've been talking about the whole time. The bank moves the money, puts money into it every single year or month or however they do it. That value builds up. They keep using it and using it. That let's call that VP Joe. Joe, retires. He starts getting his paycheck for the rest of his life, but then Joe dies. Joe graduates. Okay. The bank I should say the insurance company pays $100,000 to Joe's spouse. How much money just gets paid back to the bank? I don't know, but millions.
The bank's the owner. I mean, that's the whole key.
Bank is the owner.
I can have a policy on every kid I have, a grandkid, a wife, right? Or if you have a policy on an employee, you're the owner of the policy, so you're the one getting the cash value,
right?
Everything, the benefits from it.
Or how about your business partner in real estate? There's a lot of partnerships. So now you got a partner in your LLC. Well, each of you should have a banking policy on one another. You're the insured on one, you're the insured on the other. If one of you pass away, a check's going to be paid to the company, and it's all the same thing, folks. All we're doing is moving money. This isn't about life insurance. That's just an added benefit. This is about learning how to move your money and treat your money the same way the wealthy and the banks do.
Can foreign nationals, all North Americans, is there any boundaries by location?
Okay, so there is, but not so Canada. We can do this. So I can help any Canadians get this done. We have partnerships with Canadian firms up there that basically can get this done, no problem. Anybody that lives in the United States that has a residence and a bank account and an EIN, a TIN number, or social security number can get this. So I hope that answers. But we help a lot of people that are not permanent residents of the United States, but because they have a bank account, they have a job and an address here, they can get the policy. I cannot do policies in Australia, the UK, a lot of Asia, and a lot of Europe. We can't do these. But in Europe, this does work, but it's funky. And I talk to people from all over, and I'm like, why is your government so weird about this? Well, the government wants to be in control, and this takes control from them.
Got it. There's some other questions too, yeah.
How much would you recommend is a good ballpark number to start a policy with?
It's a great question. Whatever number you're currently saving, like where's your money going today? Are you putting money on a monthly basis in a checking and savings? Are you putting money in a 401k above and beyond the match that they're giving you? These are places where you're putting money. So why don't you just start with taking the money that you're already putting somewhere and then change one thing and put that money over here? There's really not a right or a wrong amount or a suggested amount. It's whatever number you're comfortable with. Because I can tell you, out of 3,300 members, people that we help with this banking and set up their policies, 91% of them start their second banking policy by the second year because they didn't start the first one with enough.
Is there a minimum? Is there a minimum amount?
Yeah, 10 times your age.
10 times your age. Luke is asking, in Nelson's book, he talks about imagination. Chris, what are some of the ways you've seen the most unique situations you've seen people use these policies?
Just this morning, and this is kind of ironic. It's not the first time I've seen it, but one of the things a lot of people hate more than anything is paying taxes. And if you're a self-employed individual and you have to pay taxes, the government makes you make quarterly tax payments. I'm sure all of you will agree, when you write that quarterly tax payment, your hands twitching, you're swearing so deeply inside, you're just like, you sons of, but you write that check and you mail it off to the government. What's the government do? Well, who knows? They don't do what you could.
They don't do
so
what we want to do.
People hate paying taxes. So what we do, remember I told you I can show you how to get all the money back for every car you'll ever buy, drive, and own? Well, I can also show you how to get every single penny back for every tax that you pay the government using this system. It's so simple. So that's one of the most creative, unique ways I've ever seen it used. But we got a client, and he loves cars. He loves BMWs, and he started with this. His dream was always to have a BMW. So he's got the BMW, but he funded it with his banking policy. But then what he did is, he basically got all the money back for the car while still owning the car. And just so everybody knows, to get all the money back for every car you're going to buy, drive, and own does not involve you selling the car. Okay. So what he said is, he says, okay, but the car still has value. So what I'm going to do is I'm going to sell that car that I just got all the money back. And this guy's on our website, just so you know. I'm going to sell that car, but I'm going to be the bank for the person that buys it, because I'm going to ask, hey, how are you going to buy the car? Well, I'm going to take a loan out through the bank. Whoa, hold on. What if I loan you the money for the car and I take a lien on the car and you pay me? What would you pay the bank? What would be a good interest rate? And the person's like, I don't know, 6%. Great. You pay me the 6%. So what he does is he uses the banking policy to buy the BMWs. But then when the BMW loses its new car smell, he sells the car and he funds the next person's purchase with a loan from his banking policy. So he's making money like 3 different places doing that. I thought that was one of the most creative ways.
Yeah, that is. Wow.
That's like a wrap.
That is.
Oh, it's so fun. I mean, there's nothing you can't do with it. It's just like how creative and how much imagination, like Nelson Nash, can you imagine? I mean, in Nelson's book, my favorite one is where he talks about, I think it's his son-in-law, buying all that forestry equipment, those big trucks that he was leasing and paying exorbitant amounts. And then he said, well, I'm going to use this system to buy the trucks. And he did that. And it shows the example of how he does that over 20 years. It's purely fascinating.
And one thing before we wrap it up, it's key, right? I know you say in your book, the key thing is you should be able to get a loan right away, as soon as you can, right? So if you put, 10 grand in there, get a loan as soon as you can, because that's the power of the policy, paying yourself back through the loan.
Sure. Thank you so much for saying that. One of the biggest mistakes I see people make is they start these plans and they're like, I don't know what to use the money for. So they just leave it sit. We already talked about the stagnant pond, and you wouldn't eat fish out of a stagnant pond. So why would you leave your money sitting stagnant? Find something to use this money for. Find somebody that needs the money that you could lend it to on a safe basis. I mean, there's never anyone that can sit there and tell me that they don't have somewhere for this money to go, because everybody pays taxes, everybody likes vacations, and everybody's, at least I think, buying or driving cars. So there's 3 things that are staples in everybody's life. The rest you can figure out yourself.
Chris, as far as funding, let's say real estate deals that sometimes time sensitive funding issues arise, how fast can we pull money out of these accounts?
36 hours. But let's just say you found a deal, but it's got to close tomorrow. No problem. Pay the wire fee, which I think is $25 or $30, and the money will be in your account the next day. Listen, I've tested this to wow people. They're like, wow, how long does it take to get my money? And as they say that, and I just keep going, I'm actually logging into my account. I'm clicking the button after I put my codes in, clicking the button, putting max loan, clicking another button, then it confirms where I want it to go. And I just select the bank, because I attached my bank account. And I said, okay, well, that's how long it takes. He's like, well, what do you mean? I'm like, I just did a loan. I'm not going to send it to my bank, but I just did a loan in the time we were talking. And that's how simple it is. Got it.
Now, what about an initial? Because I know some people think, okay, I'm going to put it in there and it's going to be locked for a certain amount of time, right? So how?
30 days.
30 days. Got it.
It's always, and it could be less, but it's just nice and safe. From the second you make your deposit, expect it to take 30 days for your first loan, because obviously you got to link your bank account. There's some forms you got to fill out. It's going to take 30 days.
Perfect.
I first was introduced, and I ended up getting a policy in Prudential, which I'm not listening to this. I'm like, I need to go back and check this out.
Prudential doesn't work.
I read the book Misfortune 101. I don't know if you're familiar with that book, but it was about repositioning your equity of properties into life insurance policies that gave back return on investment that you can pull a loan from. And that is when I first, about 10 years ago or more, looked into this. But that policy, if I'm not mistaken, wouldn't allow me to take a loan out till I don't even know how many years. I think it was 10 plus years.
Yeah, it's a surrender fee. It's a universal life that you probably bought, because that's what Prudential's big at.
Okay. Yeah.
That's okay. Your mindset was right. The concept and the theory was right. The vehicle was wrong.
So now it's about finding the correct vehicle to be able to have more flexibility and leverage it. Now, I'm about to have a big life experience in a couple of weeks. I have my son being born.
Yes, I just had a daughter. So exciting. I'm so happy for you.
He's scared, Chris. He's texting me every night. He's scared.
No way. Dude, it's so magical. My daughter's now 12 weeks old, but it's just magical. You should be scared, but the scared is a good scared.
I got 5. It's awesome.
When I'm up at 4 a.m, I'll text both of you guys. No big deal.
I'll probably be up.
I will be up. I know. Yes.
Now, on my to-dos was figure out the proper investment vehicle for him as soon as possible, because I don't want not a day to go by where I'm not already setting something up. So with that in mind, is there something in your strategy that would make sense for a life circumstance that I'm about to step into?
Oh, absolutely. So the first thing you do, you go to that little link below my picture there, chrisnoggle.com/resources, and you and your significant other, your wife or whoever it is, watch the 90-minute video. And that 90-minute video will answer that question. And then if you're super excited about that, there's another video, which I don't know what it's in there. I think it's called Privatized Banking, that shows exactly what I did for my daughter, Viviana. So that actually, maybe you start there. Start with that video, Privatized Banking, and it'll show you what I just did for Viviana using this concept, and it will blow your mind.
Perfect. We got another question from Molin. How do you account for windfall of money?
I'm so glad that came up. I was like waiting for like this question to come up. So windfall money. So what we've talked about so far is making annual deposits, making, systematic monthly deposits. But what happens when you get a big windfall money? You got all this money and you're like, oh my God, hot potato, what do I do with it? You do what's called a dump in. So we have to structure these and build them, but you can take like a big chunk of money, dump it right into the insurance company's general account, but then we have to structure the payments. So we have to follow those MEC rules, the IRS rules, but that's how we do it. I just did this. I do this a lot, but I did a big one for someone. They had a windfall of a lot, $660,000. So we dumped the 660 in because they had immediate uses for a lot of that money. They had to pay a bunch of debts off from their business and everything. So we dumped the 660 in, and we're immediately going to take it out, pay off all their debts, recapture the money, and then we set up, I can't remember how much, 40 grand a year, 50 grand a year we're putting into the plan every year thereafter. So that's all. We just build the plan to accept the windfall, and then we just have to follow the rules with the deposits that we make there on out to make sure that everything's in line with that stupid IRS rule that we have to play with.
That rule you're talking about, the IRS rule, is for the whole part of the policy, right? So if I set up a policy today, I have to give you the total amount I want to put into it, not the yearly amount, but the total for the policy.
Correct. Do we have a few minutes? I can just explain it because it's an important thing. Yeah. So the Max 7 pay rule started in 1988. Before 1988, there was no restrictions on how much money you could deposit. You could just, oil tycoons were dumping billions of dollars in these because obviously, why not when you're making that return and it's tax-free? So the IRS put this rule called the Max 7 pay rule, which basically is a simple way of understanding it. It says, based on the amount of death benefit we have on the policy, you can only put X amount of money away based on the death benefit over a 7-year period. So if we have X amount of death benefit, over 7 years, we can put a certain amount of money into the plan, hence the Max 7 pay. So we have gotten very creative with, and the insurance companies have, with how to design these. Because to have more life insurance, more death benefit costs more money. So we've found ways to get a whole lot of death benefit for a very low price so that we can do a ton of money in the plans all at once. So again, that's just the things we had to learn how to do and work with the insurance companies. But that's all the Max 7 pay is.
And guys, understand, Chris is doing these policies for people. Like him and his company, they are life insurance reps. So if you're looking for, if you're wondering where do I go, this is where you go right here. He can actually get you set up. I had a phone call with him last week, right? And I had my paramed appointment today. So I'm looking at my stuff going right away.
Well, the one thing too that's different about us is this is all we do. And we didn't really talk about it, but the other thing we do for all of our members is the mapping, which is basically, sometimes the daunting part is not starting the specially designed and engineered whole life. It's the banking part. They're like, I don't know how to do that. I don't know how to track that. Great. We do it all for you. We have a full team that works with every member for free. And we basically design what we call the map and the cash flow tools for you. And we help you manage that banking aspect. And we do all that. Yeah. And the only thing I ever ask is, if there's probably people that will be interested, it's mandatory. You have to watch the video before we talk. I will not talk to anybody until they've watched the video because it's just like me speaking a foreign language. So again, there's the link. You just go to the chrisnoggle/resources, watch the 90-minute, and then right underneath that, there's a tab to schedule a time with me, and then I'll just answer all your questions.
All right. I mean, listen, I think there could be a couple more shows tied to this.
Oh, yes. So, we hit the surface, and that's if that.
So we got to have you come back on.
There's a couple of guests that come on our show that I know a follow-up show is definitely needed. So here's a commitment that we'll make to you, Chris. We'll get started on our policies. We'll start going through the process. We'll start moving some money around, and then we'll schedule something where within a few months from now, we'll have you back, and we can kind of track from this show till that show, and then start actually kind of documenting how we can grow this thing.
Oh, it's like a case study. That would be awesome. And then I'll have a little whiteboard behind me, and we'll like talk about how crazy can we get with this? What can we do?
Yeah, let's do it. I'm down with that.
I love it. I'm 100% committed to that. I love that idea.
Okay. All right, guys, there's a couple questions. If this is going to be on the YouTube channel, it takes about 24 hours to kind of process. That's YouTube's thing. So by tomorrow, this should be out there. And this one's a hot one. And I'm sure you guys will have plenty of more questions. Go to his website. He's been talking about it all show. Watch the videos. That's the first thing I'm going to do this week. Come on the journey with us. This one right here, being your own bank. You guys hear us preach it 24/7. Jay's even got T-shirts for you. We are excited about the journey that's to come. We appreciate you, Chris, for coming on the show. Jay, you got anything before we let go?
Hey, Chris, man, just thank you again, man, for coming on the show. You know, he saw my picture. He made the ad. I saw the ad on Facebook the other day for the book was my picture. So
I loved it. I told you, I loved it.
You know, we got the same hearts, the same minds. We're all in the same place, and so I appreciate you coming on the show, guys. Tomorrow, 1:00, we're gonna be doing the show again. We'll have Pace coming on tomorrow, doing some creative financing stuff. I gotta have Pace gives you too. You know, Pace is in the same creative, be your own bank mindset too. So. We just really want to thank you for coming on today, man. Dropping all this knowledge.
It's my pleasure and really my honor too. I'm so happy you guys brought me on. You guys were awesome.
All right, guys. There's still more questions coming in, but it's already past an hour. Trust me, we will get back to you guys on another episode of this show, and reach out to Chris's team directly. We are out.
All right, guys.